Thank you very much for joining me, Dion and Pierre. It's always great to catch up, especially with what we're seeing in financial markets and what we have seen during 2023, and what is to be expected during the next year, 2024. It's been an interesting year from a geopolitical perspective. We've seen a lot of volatility, a lot happening. Obviously, that's obviously influenced financial markets and gone back to our portfolios. But I think the biggest driver is obviously, where we're finding ourselves from an interest rate perspective. This interest rate debacle has been going on. Fed yesterday once again kept their rates flat, with Mr. Powell warning that a March decrease in rates is not necessarily what is to be expected. So yeah, it's very, very uncertain as to where we're going, and we know that financial markets are, especially South African markets, are well priced, and we spoke about that last year. So relative to what we're seeing, Dion, and the levels that we've seen, and the macro concepts that we identifying, how did we do during the 23 year from a performance perspective, in specifically our Navigator model portfolios? Would you mind just taking us through the fundamentals of what we've done and relatively how did we perform?
It's been a good year, especially the last quarter of 23 was an excellent quarter. Markets expected interest rates to decline this year and therefore rallied in that last quarter of last year. So all the portfolios has performed well, from low risk to a high risk. The low risk portfolio like Navigator Income delivered 10.5% last year versus cash or money market funds of 8.06. So that's quite a significant outperformance in a calendar year of 2.5%. We don't expect that level of outperformance to continue, but we should still continue to outperform money market plus 1% going forward. But it's been a terrific year for that portfolio. But other portfolios that include equities like cautious, balanced, flexible, the more equities in the portfolio, the better the outcome was last year. So cautious delivered 11%, much more than inflation of 5.1%. So and then on flexible, that's taking maximum risk according to Reg 28, which is according to the Pension Funds Act, that 14.6%, much better than the inflation of 5%. Our worldwide flexible portfolio performed very, very well, the Navigator Growth portfolio, because it includes much more offshore exposure. That delivered almost 18%. Local equities struggled last year at only 7%, but global equities, after a very disappointing year in 2022, when it delivered minus 15% in rands, it recovered last year with a 28% return, and that includes some currency weakness as well, which contributed to that performance of 28%. Our post-retirement portfolios also performed very well. Low risk portfolios 12%, high risk close to 13% and slightly above 13%. So it was really a good year all around. Even our US dollar portfolios delivered very good returns. Our equity portfolio did 20% in dollars, and like I showed in rands, that was about 28%. Our global balance did 10.4%, and our cautious portfolio, despite having 50% in cash, still delivered a very decent return of 9% last year. So across the board, from low risk to high risk, local to global, most portfolios delivered excellent returns last year, and that has now also increased the returns over 3 to 5 years.
Fantastic. Dion, from a management perspective, is there any fundamental changes that we're looking at in terms of different styles or style blending? Have we possibly changed our asset management style in any way in terms of the funds that we're choosing in the different portfolios, or are we still interpreting what we did last year to be relevant?
So no drastic changes. All the portfolios are well balanced between the different styles like value, growth, quality, and momentum. So it's been already well balanced. We're just tweaking the portfolios at the margin, but there's no drastic changes because it's already well balanced. Just in our income portfolio last year, we replaced one of the fund managers, Coronation, with Prescient. The reason is that Prescient income provider just deliver much more consistent returns. And they also provide some exposure to unlisted credit opportunities, which Coronation can't access. It's only 10% of that fund, but it provides a much better return than in the listed space. And Prescient, they've got a team dedicated to analyzing these credit opportunities. So we just switched Coronation to Prescient because they've got a broader set of options available to them. And during the past, they've delivered much more consistent returns than Coronation. So that was the only drastic change. Like I said, in the other portfolios, it's just at the margin, we will tweak the portfolios. And where possible, we are also taking profit and taking that profit back into our short-term silo. Because like I showed, it's been quite a good year. So where possible, we'll take rather profit, because as we're going to discuss now, there's a lot of uncertainty going into this year. And for that, rather take profit and pocket that profit.
Absolutely. So thank you very much for that, Deon. So maybe that now leads us into Pierre's feedback. So Pierre, given our positions and the portfolio construction, we all well aware of the geopolitical risk, the uncertainty in the Middle East, and globally really, with no clear direction as to where this is going to end. How do you interpret this when you advise us on the portfolio construction, or Naviga more specifically? I mean, how do we make sense of this? What is your view? How do you expect markets to react during this period, and how do we manage those risks without compromising the upside? I think sitting with clients, it's always a concern to find that balance between the amount of risk that we're taking and the upside. I mean, sometimes, and I had a discussion yesterday, for instance, where we spoke about a very isolated section of the market, and the Magnificent Seven plays a fundamental role and sort of skews the numbers. How do we interpret, not increasing risk, but still, generating some upside whilst mitigating the downside?
Thanks, Ashana. Yeah, I think those are very important points that both Deon and you made. So I think I'll pick up on Deon first. And I think taking a bit of profit from the very good returns we had at the end of last year is appropriate. One does get the sense that we've borrowed a bit of returns from the future into the last quarter of last year. And it's understandable because, the news flow turned positive at the time. People got more optimistic about inflation, and I'll touch a bit more on that now. And the Fed, turned a lot more dovish, and that's what really kind of set the market alight. But leading on to your point, to find that right balance between the risk-taking and protecting your capital is very important, because there are still, in our view, some orange lights, if you want to call it that, regarding the world economy and inflation and interest rates. And one needs to not only kind of, react on how you feel and how desperate you are for returns, you can put it that way, but you might also look at those facts and say, well, if the good case scenario that I want don't necessarily transpire, how have I positioned my portfolio to make it robust? So I think the big topic for last year was obviously that many managers and investors were caught out by the strong returns that we received, because there was a lot of talk about recession. Now, why did the recession not arrive? And has it been permanently averted? And the answer is really the US economy remained a lot stronger than what everyone expected. And part of the reason is that consumers are in good shape. They received a lot of stimulus checks and support during the COVID period that they bulked up eventually and then spent down. So that supported the economy, but that is coming down. And the one fact that you can see in the graphs is by the middle of this year, US consumers are going to be out of their extra spending money, if you want to put it that way. And the question is, what happens at that point? Does that then cause pressure on the economy? From an inflation point of view, and maybe I can just show a graph or two, the point is really that the US Fed, and they lead the market obviously in terms of policy, and their economy also leads the market, and other countries won't necessarily go in a different direction. Now, the US is about halfway with getting their inflation back to where it needs to be. They want it at 2%, which you can see this greenish and blackish lines are the long-term inflation numbers, 10-year average inflation. That's where the Fed wants the inflation rate. The core inflation that the Fed watches went as high as almost 6% in the last number of years. Then they increased interest rates from close to 0 to above 5%. that is having an effect. It is cooling down the economy and inflation has come down, but now it's around 4% and they need to get it to 2%. So they're about halfway. That's point one. And point two is interest rates take time to work through the economy. Now, at the end of last year, the market became more optimistic because the Fed communicated effectively that they're pausing and are at the peak of their interest rate cycle, so they're not going to increase further. And the last hike they did was in July last year. So we're about 8 months past the last rate hike. But the question is, how long are they going to keep it high? And that's a point of risk for portfolios for this year. There is a discrepancy between what the market expects and what the Fed say they're going to do. The market, in the way it prices it into the bond prices, say the Fed is going to cut interest rates this year by 1.5%, and they're going to start in March. And the Fed says, and they reiterated it yesterday, they're going to cut by 0.75%, so half of what the market expects, and they're not going to start in March. They're only going to start in the second half of the year. Now, that creates a tension that can create volatility in the market, because as the year walks on and we get to March and nothing happens, and we maybe get to June and nothing happens, that tension will cause volatility in the equity market and in the bond market, because the market will then in all likelihood wake up and realize they need to make some adjustments in terms of the valuations and what they expect for the future, because clearly the Fed is not on this very positive trajectory than what they are. So,
and we actually saw that, sorry to jump in, we actually saw that yesterday with some of these tech companies coming back quite sharply based on that news. I mean, we saw Microsoft and the like pulling back, quite significantly for the day.
And those companies that you now mention is what we call long duration investments, meaning they are very sensitive to the interest rate cycle. So, or the yield. So if the expectation is that the yield is not going to come down as quickly as expected, it influences their prices negatively immediately. So to sum up, I would say there's three main points. The one is inflation is coming down. That's good news, but it's about halfway where they wanted to get to. That's going to take time. That brings you to the question as to whether the Fed will cut interest rates soon if they don't see the evidence that the inflation is coming close to 2%. I think it makes sense that they will be cautious, and that's what they're saying. They're going to be data dependent, and they're going to look at it carefully before they start cutting rates. And then secondly, and that's the point I touched on just now, interest rates take a year or more to work through the economy and affect companies and affect consumers. Now, if you take into account the last rate hike was only July last year, we're 8 months forward now. That means in the next 4 to 12 months, the effect of those last increases is still going to feed into the economy. So there is economic pressure coming on companies, on company earnings, and on consumers, even if interest rates just stay where they are. And that one also needs to take into account. Now, one other complicating factor that is arising currently is geopolitical risk, which you mentioned. And what this graph shows is containerized freight rates that went up with 23% this month so far because of the problems around the Suez Canal and the attacks by the Houthi rebels on the shipping. Now, if this persists, it could become inflationary because shipping containers and getting stuff where it needs to be on time, this big spike is obviously the COVID choke on shipping stuff around the world, and you could see what that did to inflation of these rates. Now, we're not near those levels, but this line, the longer it stays elevated and the longer those geopolitical tensions in the Gulf persist, the bigger the risk become that this inflation number is not going to fall as smoothly to the 2% as what we wanted. So those are kind of the risk factors to point out, and we've now touched on it. But what's the better news? The better news is in South Africa, we are currently blessed with good valuations, much better than the rest of the world. Now, it can be a long debate as to whether we are priced correctly because of all the internal problems, but to a degree, it also relates to emerging markets not having been in favor or in fashion, only the US having been in favor. And the fact that we had, because of our own domestic situation, lots of outflow of international investor money, and that depressed our prices. Now, if a few things start going right in the world, eventually the world economy start growing again, China maybe get their act together, and foreign investors start looking, their risk appetite increases, and they start looking at emerging markets, including South Africa again, then we have a very good starting point in South Africa to generate good future returns. So this graph shows our equity valuations relative to their long-term average, which are those red lines. And you can see the all share is cheap compared to its historic levels. Compare that to the US, the S&P 500, that is, one can debate how expensive, but arguably quite expensive compared to its long-term average. So I think that's good news for South Africa, that our equities and our bonds that currently offer you double-digit yields are offering us, from this point forward, the valuation levels at least, to deliver good prospective returns. There's obviously a lot of economic risk around inflation and interest rates. There's geopolitical risk. There's, around our own elections and so forth. But as time goes by and these things abate, and the environment normalized to an extent, I think we have a very good starting point. So we speak to a lot of managers, and I'm sure yourself and your clients listen to some of them and read what they publish. And many managers in South Africa expect that our market over the next 3 to 5 years can give you equity returns of between 10 and 15%, or even slightly higher per annum. And our bonds maybe in the high single digits or the low double digits. But very importantly, it's not going to be a smooth ride. It's going to come with some volatility. So you have to stomach that in the first place. And in the second place, you need to construct your portfolio in a very well diversified way, as Dion indicated, that can absorb the swings that the market will invariably make. But to reiterate, the starting point is good. Volatility might happen, but we and managers have a reasonable expectation for decent returns in the next number of years.
So Pierre, just to summarize sorry, Dion, go ahead.
Just one point to add to that is that our equity market can perform well despite the local factors. For example, last year, Brazil, Argentina was one of the best performing markets in the world in dollar terms, not local currency, dollar terms. The previous year in 22, Turkey was one of the best performing markets in US dollars. And that's despite hyperinflation, high interest rates, political instability. So it just shows it's all about the valuation, that your market can still perform well despite local domestic factors that is negative. It's all about the valuation, because those markets like Brazil, Argentina, Turkey, they were all cheap and was able to perform well in US dollars despite their local factors.
Yeah, so Dion, I think what you're saying is there's no real correlation necessarily between the economics and what happens in markets necessarily. Yes. In this case, for instance, a possibly tilt towards emergings might cause for South Africa to follow in that tailwind, if I understand you correctly. So despite geopolitical risk internally in South Africa, despite energy constraints, etc., these are factors that we're dealing with on a daily basis that would not necessarily imply that we in a negative market valuation perspective. So could only go better from there, if I'm not mistaken, if these things are sorted out, obviously, the sentiment returns and so forth. But we do have the opportunity to grow the portfolio, even though there's this volatility applicable. Am I right?
Yes. Pierre, do you want to discuss quickly the currency?
Yes, I just want to touch quickly on the rand, Luciano, to give the explanation as to why we are not at the absolute maximum foreign exposure in our portfolios that we are allowed to have. And the rand is a big part of that. The rand is, together with other emerging market currencies, too weak on a theoretical basis versus the US dollar. Now, the timing of how and when the rand strengthens and emerging market currencies strengthen, and effectively all non-dollar currencies strengthen against the US dollar, is uncertain, but it is at extremes. One must acknowledge that the dollar is 20% plus too strong versus most other developed market currencies. It is 60% too strong against the yen. The rand is 40% too weak against the dollar compared to where it should theoretically be. The rand is 10% too weak against other peer emerging market currencies. So even against our peers in the emerging market, we are abnormally weak. And that just gives us the sense that it might be a bit stretched. And I hope you can see the graph that I projected. But when the rand gets to these very blown out points, it does tend to come back a bit after that. Obviously, the longer term trend, because of high unemployment, economic inefficiencies, inflation differentials, the long-term trend is one of weakness in the rand, and over long periods of time that work out to about 5% per year that you lose in value in the rand. But from time to time, it makes these very weak movements, and then it tends to come back a bit. So we just think, combine that with the good equity and especially bond valuations we have in SA, we'd rather not be at full 45% max offshore, but keep it in the 30s or in the high 20s, and maybe we'll get a better opportunity to take money out of the country in the next year or two or so.
I mean, also just to add on to that, Pierre, then the local companies that we hold in the portfolio are also dual listed, many of them.
Exactly, many of them
which
are.
Also gives you that revenue from that revenue stimulus from the offshore environment.
So more than 60% of all share earnings come from overseas anyway. So it is a case of you can buy depressed companies in South Africa that are depressed because of whatever the sentiment might be, but their earnings, as Deon I think also alluded to, are not linked to the SA consumer necessarily. Many of them get a high level of their earnings from overseas.
Fantastic. Gentlemen, thank you so much for your insight. That was very comprehensive and I think right to the point. I think just to summarize, it's to our clients, it's absolutely volatile. I don't think the volatility, as my colleagues on the call today explained, is necessarily is not to be expected. It's definitely going to be playing a role going forward. But I think what's imperative is that we're doing a lot of work in the various components of the business to manage that risk and to make sure that we find a balance between the upside and the risk for our clients, and we will continue to do so. So, gentlemen, thank you very much for your time, and to our clients, thank you for trusting us with the management of your capital. And please don't hesitate to give me a call if there's anything that you require in addition to what we've discussed today. I'm more than happy to facilitate a deeper discussion if that's necessary at any point. So, gentlemen, thank you very much. Good luck with the rest of your week.
Thank you.